Welcome to Over the Horizon, a Bitcoin podcast. Here with me today, I have Jesse Shrader, founder of Amboss, and they've just released a very new cool product called Rails, which we're going to talk about today. We're going to talk about everything else. Jesse, how's it going? This is our second time trying to do this.
It's going great. Yeah, every conversation, Joe, it seems like things just get better and better. Bitcoin price is pumping every single time we have a conversation. So I'm excited to kick this off.
Absolutely. Time value of Bitcoin. Let's start there, and then we'll talk about your story as a founder. But first and foremost, where are we today? Where were we in 2018 when that piece was first published, and where are we today? What has changed?
I think 2018 was really where Lightning Network, the white paper was published for the Lightning Network, and we were trying to explore what was this whole idea with Bitcoin as a medium of exchange. Like, how is Bitcoin going to scale? Because in 2017, Bitcoin transactions were costing actually about $60. That was one of my first experiences with Bitcoin transactions. And I was trying to look for some way to reduce the cost of transactions, make the transactions work faster on Bitcoin. And that's where I got into the Lightning Network. It was super early. Lightning Network was just getting started, and I stumbled onto this piece by Nick Bhatia called The Time Value of Bitcoin. And it was really laying out this idea that there is potentially yield to be acquired at very low risk by using the Lightning Network. And the way Nick had framed this up was that you could essentially earn fees from payments by putting your Bitcoin to work on the Lightning Network. And that was a huge inspiration. And, while I was trying to make Lightning work better and, Bitcoin scale better by creating Amboss, one of our first products, and really a flagship product to this day, is Magma, which was a marketplace where people could buy and sell Lightning channels, which is like creating new connections on the Lightning Network, meaning you're adding destinations where you can pay with Bitcoin at super high speeds. And all of those channels that were sold, people are earning yield off of it. They're getting paid to open new channels. And it was actually, like, for the first time, really making it possible to earn yield without giving up custody and setting up the infrastructure on which to earn yield from routing payments. So that was 2021, really, when we launched Magma. And from there, it was a very manual process when we first launched it. But now we've got Rails, which is completely automated version of this, where you can essentially just deposit Bitcoin. That's all you need to do. And it is in complete self-custody. So you're going to get your own Lightning node, and you don't have to manage it because Amboss is now providing a service where we'll open and close your Lightning channels, we'll set the fees, we'll be tracking the market, and really your job as the asset holder, the liquidity provider here, is really just monitor and be able to see the transactions come through, whether you're routing payments or leasing liquidity. You don't have to understand what those mean. All you have to understand is how to do self-custody.
Beautiful. And that's something that the market sorely needed, because people have been able to capture yield on the Lightning Network for some time now. But there needs to be something that strips away all of the technical speak. When you go to a bank, they don't tell you how a savings account works. When you buy a U.S. Treasury bond from the U.S. Treasury at your bank, they don't tell you, or through Treasury Direct, they don't tell you what they're doing to earn that yield. It just works, right? You buy it and it works. Or in this case, you're posting your liquidity and it works. So that's fantastic. That's amazing. I want to backtrack, and then we'll get back into the discussion, and we'll talk about some visuals so we could tell people watching this how it works, about what the story is. You spoke a little bit about your story with Amboss, founding Amboss, creating Magma. How'd you get started in Bitcoin? We tried to do this show yesterday or the day before, and we had talked about this pretty high level, but you have a really interesting backstory about how you actually wound up building a Bitcoin company. So I want to hear about that.
Yeah. So I studied environmental engineering, and I graduated at an inopportune time because we were still recovering from the great financial crisis, where there was just way too much leverage in the system and a whole bunch of fraud, and it caused the economy to have a very slow recovery. And because of that, I ended up, searching all around for jobs, taking a temp job in a call center. And that call center handled, of all things, class action lawsuits against banks, mortgage lending discrimination, identity, basically major security breaches, and also the Mt. Gox case was also handled in that building. So really I was in that call center talking to people that were victims of banking policies where they kind of reorganize debit card transactions and maximize overdraft fees, or, different financial tricks or securities fraud cases. But it was fascinating. And I was looking for an alternative. Like, show me a bank that isn't engaging in these. And I really couldn't find one in any of these practices. So stumbling onto Bitcoin and, after getting excited about the, exciting price movements that it has, realizing that it's fundamentally different because it operates on consensus, where you can't institute adversarial policies. It doesn't rely on credit and debt in order for the entire system to work. So that's really what got me fired up about Bitcoin. But then, of course, it appeals to the engineer in me because it's this beautiful system, but it's a little bit clunky. So there's tons of opportunities to innovate. And being that it's open source, basically anyone can work on Bitcoin to make it better. It's made better by regular people. You don't have to be a hero. You don't have to have a whole bunch of technical developer skills in order to contribute meaningfully to Bitcoin. I mean, one of the things that actually made Magma exist and made Rails exist today is because I read a phenomenal paper by Nick Bhatia, which then you added to dive further into, the time value of Bitcoin and the time value of Lightning. So really, that's kind of what brought us here today.
Incredible. Just incredible. I want to talk about this, the concept of increasing the velocity of money without credit. Credit creation, which currently allows the world to go around, means that banks lend money into existence. With Bitcoin being an absolutely scarce monetary asset, you can't do that, right? It requires proof of work for new issuance. And one day that proof of work will dry up. New issuance rather will dry up, right? And then proof of work will only be used for transactions on the main Bitcoin network. What Lightning does is it enables those payments to move faster. It increases the velocity of money. It reduces the cost. And it does it without credit. And so this is an interesting concept that I want to dive into because I think it'll frankly be the core of our episode because it's a totally new concept. The idea of a global economy that doesn't run on credit in order to make the world go around. And why Bitcoin is the only asset in the world that, enabled by the Lightning Network, is the only asset in the world that can enable that. You and I both have unique perspectives here, so I guess you can kick it off, and then we'll go into a discussion about it.
Well, you're interviewing me, but really I want to interview you because you put together this correlation between global M2 and the Bitcoin price. And
Yeah.
I get asked about the Bitcoin price all the time, as a founder, as a thought leader in the space. But, I'm linking to your correlation that shows that, the global M2, which is like global liquidity, has a relationship to the Bitcoin price. And with that, I'm thinking, what is global M2? Just to figure that out. And I was trying to explain to my friends and family that like M2 includes loans. So in order to make, well, and you would have a better sense of this than I would, but in order to make money move around the world, you basically have to create new loans, which is how the fiat system operates. But Bitcoin, by with this correlation, is showing that it is fundamentally different. The more money you create, the higher the Bitcoin price goes up with a lag. Maybe you could kind of explain this whole situation, why we're seeing this.
For sure. So global M2 is, so I want to give a definition to the audience. Global M2 is different from liquidity. Liquidity is basically credit conditions, right? Credit conditions obviously meaning how easy it is or how hard it is for someone to get a loan. And different things go into this. Namely, the big components are treasury price, treasury volatility, and the level of interest rates, right? Those are three of the biggest components, as well as global money supply. But primarily, it's treasury volatility, treasury price, treasury yield. And global liquidity, it's a chart that you could take a look at. And it's extremely easy to extrapolate where risk assets are going to go because we talk about the world runs on credit and credit creation. If there's less credit being created, if conditions are tightening, global liquidity conditions are tightening, then risk assets are probably going to fall. You can't print money into existence. The carry trade basically becomes less profitable for banks, and so then you move into a risk off environment. And in the vice versa, when liquidity is expanding, it means that animal spirits get reignited because credit conditions are loosening. And so global liquidity is a really great oscillator to use. Now, this chart, Global M2, it's slightly different. Global M2, it's basically a monetary aggregate. So it takes M1, which are all of the most liquid forms of money. So physical currency, checking accounts, other checks, whatever. And it adds in savings deposits. So, basically in a savings account, money that can be easily withdrawn, sometimes money that has restrictions on the amount of times you could draw it out, whatever. Time deposits, so like certificates of deposit, they offer higher interest rates and savings accounts, penalties for early withdrawal, and retail money market funds. So money that is put into, this big pool of money that investors use to buy short-term debt securities, usually US treasuries. And so it's a broad, basically what it is this global monetary aggregate. It's pretty narrow, but it gives you a pretty good sense of two things: the absolute level of fiat sloshing around in the world, and then the strength or weakness of the US dollar, because global M2 in this chart is denominated in US dollars. And so what this chart does a really good job at showing is those two things. When there's a higher or when the absolute pool of global fiat sloshing around in the world increases or decreases, or when the dollar is strengthening and weakening. I'll ask the viewers, what was Bitcoin created to do? It was designed to hedge against this global pool of fiat increasing endlessly and the dollar weakening forever. And so that's what this chart shows. That's essentially what this chart shows. Global M2 shows the very same thing that Bitcoin is, right? Bitcoin was designed as an asset to fulfill this destiny, which is be a hedge against this thing. And now we have a chart that's showing this thing, and Bitcoin's correlated to it. And so people will look at this and they'll say, well, it's not an accurate measure of liquidity. I've never claimed it to be. In fact, most of the posts that I do, I'll often put a disclaimer saying this is a narrow view. This is not liquidity. Liquidity is something different. This is more of a chart that shows you Bitcoin is actualizing its destiny that is put in the, incorrectly colored white paper behind me, the dark mode white paper behind me, right? Its monetary properties, what it was designed to do, it's fulfilling those in real time. And so that's what this chart shows. It shows that basically, so long as the dollar keeps weakening and this global pool of fiat keeps increasing, Bitcoin's going up forever. Now, there's a lag because when the dollar weakens and global fiat expands, there is a lagged effect for that, 100 something trillion dollar pool of capital to find its way into this $2.2 trillion asset, and these conditions to work their way into this $2.2 trillion asset, something that's less than 2% of the size of global M2. But that you can also say, as a result of that, this correlation is going to become tighter in that the delay will become shorter and it will be a stronger correlation between the two, right? Because ultimately, this is what Bitcoin was designed to do. I'll stop in a second, but we think about equities, right? We think about why do equities exist, right? To buy a share in a private company, or a public company, rather. You buy a share of GE in the 50s, it's because you love GE, you love the board, you love whatever. You think they're going to provide shareholder value. What equities are now is they're used as a store of value, primarily, right? Rather than taking a position in a company that you care about with the expectation that that company will be worth more down the line and you're helping them invest in their operations and they use the money that you invest, that you give them to invest in their operations and increase shareholder value, earnings per share. Now it's literally just a savings vehicle. That's it. That's what the S&P 500 is used for. And that's why passive flows totally dominate the stock market and they all go into the S&P 500 because people don't want to buy a single company because they believe in it. They want to buy all the companies that are automatically rebalanced because they don't care where their money goes. They just want the best performer. And so that's the essence of investing. That's why passive flows have increased so much and why they basically solely go into these index funds. And so if the question is, if the general theme in investing is I'm going to put my capital in the fastest horse in the race and I'm going to let this automatically reweighted index do it for me, then why on earth would you not buy Bitcoin instead? Because Bitcoin was designed to do what your S&P 500 is doing, right? Whether you say it or not, I'm buying these companies, or actually, no. Ultimately, what people are doing is they're buying the stock market, they're buying the index because they want to beat inflation. Bitcoin was designed to do that, but better. And so over time, more and more people are going to come around to this. Like people don't invest in companies anymore because they expect them to invest in their operations and increase earnings per share, whatever. Maybe with Nvidia, but certainly not with Apple, right? Maybe with Google, maybe with Facebook, but certainly not with the other 400 something companies that are in the S&P 500. It's just about picking the fastest horse in the race. That's why people invest not in individual companies, but more and more in the index. And Bitcoin does that better. And that's what this chart shows. So that's kind of what this is all about. To your point about liquidity, Bitcoin does have this positive correlation with liquidity, meaning that as credit is created, Bitcoin rises in price. And you and I both know that that can never stop.
Love this, Joe, because it just paints such a nice picture about how the traditional economy relies on credit creation, and basically you have to create new money that includes risk. I mean, the other thing in that call center was bankruptcies. So that same call center handled the Lehman Brothers bankruptcy, which was the reason that I was in the temp job in the first place. And basically you're showing here that since the traditional economy relies on credit creation and Bitcoin doesn't, that Bitcoin can actually increase velocity, can actually settle global payments without introducing all of this systemic risk. It's a complete game changer. And like that's the future that I want to live in, where you can actually have a really well-performing financial and payment system that is backed with math and cryptography that like Bitcoin has enabled that. And now in order to improve upon it, now we're putting it in structures that, given that it has that solid cryptographic foundation, well, now we can start moving money faster around the world at like nearly the cost of a digital signature and have the value of that network accrue to the individuals that are creating the infrastructure, which is really the whole idea behind Rails, because, this is like introduce the concept of DVIN, which is like a decentralized virtual infrastructure network. So this isn't physical infrastructure. It's actually virtual. I mean, capital here is the infrastructure for payments. So your Bitcoin becomes a rail for you to deliver payments and to support the network be more interoperable, help your payments reach more destinations at lower cost and faster speeds. So it's really a huge game changer that when you compare it with the traditional financial system, it's just lower risk all the way down to its foundational mathematical roots.
100%. Lower risk all the way down. And it makes money again, because money has increasingly distorted the world around us fiat has increasingly distorted the world around us because things that shouldn't be investments become investments. And then we need to buy things as fast as they get on store shelves rather than whether or not you need them, right? You may not need a new car, but if you wait, it's going to be more expensive in 5 years, right? On a relative basis while you're earning. And so our way of looking at the world is distorted, and we delay things that we shouldn't delay. You delay child rearing, you delay family formation, you delay a whole host of other things purely because the money makes it so your time preference is shifted to the immediate present. I have money now, I got to spend it. What do I spend it on? Bitcoin totally flips the script, and its integration with capital markets is so exciting because it's going to make it so that investments that are made into businesses are actually sound ones, right? Not near-term ones that capitalize on trends, but it'll make business investment more sound. And capital allocation will completely change, right? The priorities will shift from the present to the future, and we'll actually start building things to last again, which is extremely exhilarating. And in that vein, I want to show this graphic, which is kind of graphic number 1, and then we have graphic number 2. This is the typical risk curve. So this plots a bunch of different assets along a curve based on their risk and their return. So I'd like you to walk us through this. And this is how the system works now. And then the next slide is how the system is going to work and is starting to work on a Bitcoin standard. And then we'll talk about how Rails fits into it and how it's game changing.
Wow. Okay. You're going to need to help me with some of this. Okay.
You got it.
Here we're starting with, what was that quote? Gold is money. Everything else is credit. So this is kind of the base of the risk return. So absolute lowest risk and no return on physical gold. That's That's the way the system works.
That's
But then
zero.
U.S. Treasuries, basically, you've got the best lender out there. I guess the lender of last resort in this case for the U.S. Treasury market. It is debt, and you are increasing both your risk as well as the returns. And then, well, I guess with U.S. Treasuries, you've also got they're devaluing the underlying, so they're printing more dollars. But okay, then you go up the risk curve to corporate bonds. Now you've got equity risk. So it's not just a country, you're actually looking at an individual company or a group of companies. And then you've got equities above that. So owning a share in a company, much higher volatility, so subject to now you're less senior in your liquidation preference. So if something goes wrong at the company, then the corporate bondholders would get paid first, and then the equity holders, if the company was going out of business. And then venture capital. I guess this is you're searching for a unicorn, searching for that really great Bitcoin startup, which can take you to the moon through the innovation and the partnerships that they create. Because that's what gets you the highest returns, but it's also high risk endeavor.
Perfect. Extremely well said. Couldn't have said it better myself. It's like you go from something that isn't credit, something that's absolutely sure, to something that's basically close to 0% sure. This is a shot in the dark. This is a surefire thing. And it's all based around this idea that fiat is constantly depreciating. And so, you have the lowest return on physical gold every year because it yields zero. It yields nothing. There's no new capital created in physical gold. It'll appreciate, but everything else will too. This is about yield, and then all the way up here, you could throw money into 50 companies before one becomes profitable. So this is an absolute shot in the dark. This is how the yield curve looks now, right? Or excuse me, this is how the risk curve looks now when it comes to investing. So we can say that this is the dollar native global asset risk curve, right? What about this one? So this is one that I created with Nick back in 2022. It was concept then based on what was being worked on. And Magma was the initial inspiration for my piece that I did in 2022 after the time value of Bitcoin from 2018. This was from time value of Lightning Network. Now, 3 years ago, the original piece is 7 years old. It's crazy to think about. But this is a Bitcoin native capital market risk curve. So let's walk through this. And it looks very similar to the last one, starting at cold storage BTC, because there is no yield on it. So I'll let you pick up and kind of explain what the other ones are, and then we'll talk about the significance of it, and then we'll talk about where Rails fits in, and Magma.
Okay. So first off, we got cold storage Bitcoin. So your risk here is protocol risk. I mean, we talked about gold as kind of the base money. But gold also has a flawed protocol where you don't know exactly how much gold is in existence. But here for cold storage Bitcoin, you know exactly how much Bitcoin is in existence. There's not going to be rare pockets of Bitcoin in asteroids that could potentially be unlocked. So basically, we've got security. So zero return and near zero risk. So, but to take things up a notch, still remaining in self-custody, you can actually take your Bitcoin and use it on the Lightning Network. And so this is going to introduce a new protocol. So this is the Lightning Network protocol, which kind of you could look at it like a smart contract on top of Bitcoin. This is really where you're going to work together with another entity to actually create super fast highway for Bitcoin transactions. And that structure enables you to start earning fees every time a payment goes through and uses that connection. So that Lightning Network reference rate keeps your risk very low because it remains in self-custody, but you're getting a small amount of payments for it. So generally, this is like 0 to 1% is what we're seeing on the actual payment routing. And this Lightning Network reference rate is really the aggregation of all of those payment processing fees across the network, kind of averaged out.
And this is the U.S. Treasury equivalent. This is the equivalent to a U.S. Treasury.
But wait, there's more because there's no lender risk that you're introducing. So
if you think there's no lender risk with the U.S. government, There is, they just print the difference. They'll never default, but they'll just print more in order to pay their obligations.
I love it. So the next step up is the Lightning Network liquidity lease. And so this is really what we introduced with Magma, because you can get paid to open a Lightning channel to another person. And if you were to make a power analogy, if you were a power company, you could make money with every electron that you deliver to a customer. But you can also make money by connecting a new customer to the power grid. And that's how you could think about this liquidity lease, is you're connecting a new customer to this payment network and allowing them to receive power, or in this case, the hardest money in existence. So really this liquidity lease is much higher returns. So historically, what we've seen on Magma is 1 to 4% APY coming out of these liquidity leases. And we're continuing to monitor this. And now with Rails, it's a completely automated process. But it doesn't stop there, because the Lightning Network recently became capable of being a multi-asset network. And we're watching this happen because Tether has announced that they're going to be issuing USDT, the most popular stablecoin in the world, as a Taproot asset on the Lightning Network. These were formerly called Taro assets. Now it's called Taproot assets, but it's the same thing, because
out of date,
now the technology hasn't changed. If anything, it's just matured a bit. But really, this allows one transaction to start in one asset, so Tether, for example, and be received as another asset. And it's swapping in flight, and it's doing the exchange. So really, if we play this out for Rails, it would mean that every single node that we're deploying for Rails could actually be doing these asset swaps and earning exchange fees in addition to all the liquidity. And then, so here you've got lending here. So this is where it's possible to lend another asset. And this is something that's just starting to be explored, where different companies actually need liquidity in particular assets to make basically need working capital. And so that's, I think, going to be one of the first applications that we'll see for lending. And then I'll probably let you talk about off-chain lending, because this is a new concept to me as a whole.
So off-chain lending, essentially what this means is, like, right now it's happening with JP Morgan, is they're talking about letting you post Bitcoin as collateral, and other places too, potentially allowing people to post Bitcoin as collateral. Now, the current conversations are around having IBIT and other Bitcoin-like vehicles held as collateral. But down the line, and who knows how far that'll be, these same banks will be having a conversation about letting you post Bitcoin to a custodial account in escrow as collateral. And so if we're talking about, things that are surefire over here on this graphic, which is physical gold, and in this case, cold storage BTC, all the way up through things that are a real shot in the dark, that you're trying to get the apex return that you possibly can, but there's a great deal of risk involved, then right here, off-chain lending is that equivalent, right? It's a great deal of risk for the bank to be doing this stuff in a way that isn't on-chain, right? You're posting your Bitcoin assets as collateral in some kind of escrow account. Maybe you're posting IBIT. It's much more risky for the lender, and therefore it demands a much higher rate of return. Lightning Network reference rate plus 300 bips, that's pretty expensive, right? If the Lightning Network reference rate is like, let's say the Lightning Network just explodes in demand, it goes to around 5%, 6%, 7%. That's what it's known to be through the years, hovering around 5 or 6%. Then LNRR plus 300 bips, you're looking at 8%. 8% being charged to a Bitcoin holder every single year, annualized. That's the riskiest aspect. And so this is something that isn't all the way there yet. You look at instances like Bitcoin-backed loans with a company like Strike. That's based off just historical lending rates, plus a huge risk premium because there's Bitcoin involved, and you can't find people who will underwrite Bitcoin at a low rate. But with the Lightning Network, because the reference rate is the prevailing US Treasury rate, the risk-free rate. But in this new economy, the Lightning Network reference rate will be the new risk-free rate that's actually risk-free, right? And then every other loan will be based off of that, right? So that will be the risk-free rate that's used as a benchmark for all these other types of lending. The liquidity leases that you could find on Magma, the Taproot asset leases, and also off-chain lending, right? Current off-chain lending, current Bitcoin-backed loans are based on the risk-free rate being the 10-year US Treasury yield, generally speaking. in the future. And therefore, they're really expensive because there's a huge risk premium associated with Bitcoin. It's the 10-year plus 1,000 basis points or something crazy like that. The lowest you could find on the market is like around 11%, around 10%. Like sub 10% is nary if ever seen. But in the future, when the Lightning Network reference rate is what's underwriting all of this, you'll be able to find an off-chain Bitcoin-backed loan for potentially 7% annually, for potentially 8% annually, right? And that's the world that we're stepping into. We're now seeing these two things emerge. We're seeing a widely available and published Lightning Network reference rate, largely thanks to you guys at Amboss. Lightning Network liquidity leases, largely thanks to you at Amboss. Taro asset lending, which is something that's going to emerge largely thanks to you guys at Amboss, and off-chain lending, which is something that will happen way down the line. But we said that in 2022. Who knows how soon it'll be occurring? But off-chain lending based on the Lightning Network reference rate, not based off a U.S. Treasury rate as a benchmark rate. So this is a lot of these things have come to fruition, and yeah, that's what I'll say there. And when I say a lot of these things have come to fruition, I mentioned you guys a lot at Amboss. What have you done at Magma first, and then how did that evolve into Rails? And then we'll talk about what Rails is and how it works and where it fits on this curve.
Yeah. So what we started with was kind of the initial liquidity leases. It's always been possible to make money from routing payments, but the yields are relatively low. But there's a huge opportunity for us to actually start leasing out liquidity. We're calling these selling channels, but really this is a lease of liquidity. So using your Bitcoin for a functional purpose. So really we started with that, and it was primarily hobbyists that were participating in that. But leasing liquidity solves a real problem for payments. In order to receive a Bitcoin payment over the Lightning Network, you need liquidity from the rest of the network, just like you need the power connection to the electrical grid to start receiving power. So that's kind of the setup. And Magma has been, up until this point, been a very manual process. But now we're automating that through two products. One is liquidity subscriptions. So really, this is kind of your monthly power bill to keep that connection going. And the other side of the market, the supply side, is through Rails. And these are liquidity providers that are working to put their Bitcoin to work. So Rails is completely automated, and they'll actually be able to just deposit on-chain Bitcoin, keep their Bitcoin in self-custody, and now it's automatically fulfilling the needs of the rest of the market that is doing payment processing at very low cost. So I think people are used to paying 3 to 4% to traditional payment processors to actually do their payment processing, and then the money doesn't show up for 2 weeks. But really what we're doing with Rails and with liquidity subscriptions is we're bringing that payment processing cost down to 0.5%. And so that means that people can get paid immediately and not have to wait 2 weeks for the payments to actually process.
That is absolutely fantastic. And it really is a game changer because currently the options available to people when it comes to wanting to mobilize their Bitcoin liquidity are relatively minimal. We saw what can happen if you post your capital on a platform like Celsius or Voyager or BlockFi, and you get these pie in the sky promises of 18% yield, 20% yield, 40% yield, right? And then it all came crashing down. The question became, where does the yield come from? And this is what I'm excited to talk about now. Because one of the things that, and you're partnered with Theia now, Rails is partnered with Theia. People could find Rails in the Theia marketplace on the Theia app and web app. So if you want to do this, you can now. Just go to the marketplace, click Rails, or go to Rails directly if you're not a Theia user. Is where does the yield come from? It was one of the things that you and I had spoken about really early on. And you guys have really changed the game with where the yield comes from because you clearly explain, you have a how it works, and you explain where the yield comes from. Traditionally, people are very wary of yield. They're scared of yield because of what I just mentioned. Celsius, BlockFi, Voyager, right? When it comes to Bitcoin, they're afraid of yield. When it comes to quote unquote crypto, they're afraid of yield. Now through the Lightning Network, powered by Rails, you could really have this plug and play yield solution on Bitcoin. And so I ask you, Jesse, the question to end all questions, where does the yield come from?
Can I show you, Joe? Can I show you where the yield comes from? So here's what it actually looks like. So basically, when you use Rails, you're depositing and withdrawing Bitcoin. And you can actually go and see the earnings and see the breakdown. So whether it's through liquidity services where you're selling channels to different channel partners, or you're routing payments. So here this node has routed 12,777 payments. So overall that Bitcoin is going to work. And out of that, out of the liquidity services and the routing services, there are actually earnings. So this is a real Lightning node on the Lightning Network, and being able to see kind of the breakdown of where does the yield come from, and it's from routing services and liquidity services. So those leases are high returns. They're not as frequent, so it's a rarer event overall, but much higher yielding. To kind of explore this, we're still in early phases for the Lightning Network, but people still need to get connected with the rest of the Lightning Network and start getting a return on their investment and putting their Bitcoin to work to make payments better.
Beautiful. I absolutely love to see it. So this works out. So this is in about a month. This is June 11th through July 11th is what I saw. You annualize that out, and you mentioned that liquidity leases are less frequent. But let's say we annualize it out. That's what you get over 12 months. That makes for an annual payout of $2,715.84. If we then divide that into, I think it's a 2.5 BTC that was there.
Mm-hmm.
Okay, wonderful. So we divide that in $34,000, divided into 234,000 times 100. And you're currently getting 1.16% every single year on your Bitcoin, and that's risk-free, right? Again, there's no liquidation risk, right? All of these risks that we talk about that are associated, and this is just the early days, Jesse. And so this is just one example of one node. It probably varies greatly. It probably varies to a tremendous degree. But the more demand there is for Bitcoin as a payments network, then the more money people could make by posting their Bitcoin as liquidity on Rails. It's just fascinating to me that now this is a huge option for people. If you're sitting on a stack of 1 Bitcoin, 2 Bitcoin, even 10 Bitcoin, like an extra, 20,000, 30,000, 50,000 a year for doing nothing. And then when the yields get better, an extra 100K on a stack of 10 Bitcoin and Bitcoin's price is higher for doing nothing. That seems pretty enticing. So I guess I'll give you a chance to comment on that. And then also, what are the risks associated with something like Rails compared to traditional lending? Like if someone wanted to take their Bitcoin and post it somewhere else.
Overall, we don't like to make the claim that it's completely risk-free because you've got protocols to deal with. So just to be as transparent and as authentic as possible, really you've got Bitcoin protocol risk, you've got Lightning protocol risk, and then basically you have to maintain a database and secure that. So of course, we really prioritize all the backups to ensure that if anything happens, you will be able to recover your Bitcoin and bring it back into cold storage, reduce that risk profile. But overall, I think what we're doing here is basically, putting Bitcoin to work and answering that major question of like, where does the yield come from, and allocating Bitcoin accordingly. But you don't have to encounter all of the risks of lending, where basically you're having to do due diligence on what are people using the money for? Am I going to get any return on investment? Are your financials in order so that it doesn't have to go into kind of a liquidation or a bankruptcy situation? So all of those risks, which are major, major risks, those all go away because you're losing what's, I think, broadly termed as the counterparty risk. So you don't have to deal with that when you deal with the Lightning Network.
Beautiful. When it comes to counterparty risk, it's one of the big things that caused the 2008 financial crisis, like coming back full circle. Writing these loans to people who had no hope of ever paying them down. Just writing them for the sake of writing them, securitizing them and selling them. The bank didn't care that the person couldn't pay their loans. They already wrote 1 million of them, secured, or 10,000 of them, securitized them and sold them to someone else. They already made their money, right? And that's the risk you run into with things like rehypothecation and counterparty risk in traditional lending. You're totally circumventing that with Rails and with posting your Bitcoin on the Lightning Network, right? For, these Amboss powered liquidity leases and the routing fees. And it's all automated, right? You guys have done it in such a way with Rails that now not only do you have this great form of lending, this nascent form of lending, but you've also done it in such a way where it's easily explained and you're handling it on the back end, and people don't have to spin up their own node and figure it out on their own how on earth do I do this stuff? And open channels left and right and basically do this, put in an insane amount of work for what amounts to very little return given the amount of time they put in. And you guys have created a service that just takes care of all of it. You guys are basically the very first Lightning Bank where you can actually go and just park your money and have what amounts to a high yield Lightning savings account in the year 2025.
Beyond that, you actually don't need to be a bank to do this, because we could actually see the end of it. And unfortunately, you do need a banking license to call yourself a bank, but you can see every single action that is happening on the actual Bitcoin blockchain. You could go to other Lightning Bitcoin blockchain explorers and see the actual channels that your Bitcoin is actually participating in. So this enables just complete transparency in the entire financial system. And really, Amboss in this case is your service provider to let you be your own bank, which is really the idea behind Bitcoin.
That's an amazing way of putting it. So what you're telling me, Jesse, is being your own bank, we're moving beyond the concept of just being a vault where the money is held in to actually being able to earn a yield on that money, except it doesn't stray away from the Bitcoin ethos of being greedy and taking an immense amount of risk. You're providing a real service. So this is the next evolution of the idea of being your own bank.
The part that I love most about Rails is the incentive alignment, where I can get folks like Bitcoin treasury companies to start thinking about Bitcoin not just as a store of value and a way to increase their stock prices, but actually meaningfully support Bitcoin by making it a medium of exchange and putting Bitcoin to work to actually solve real problems in the payment space that like meaningfully impact the rest of the world, and do that in a money that doesn't get devalued by inflation, by unfettered money printing.
Unfettered money printing, that's what we're up against. It's amazing. I want to talk about Bitcoin treasury companies briefly and the utility for them, because for the most part, what's happening now is people are becoming a Bitcoin treasury company just so they can IPO and then use their ATM access to buy more Bitcoin. And that's wonderful. It gives people access to leverage Bitcoin exposure. And many people are doing it in a way that has a very, very low liquidation risk. Their stop loss, where they have to sell any sort of Bitcoin, their liquidation level rather, is in the $10,000 or $20,000 mark. So many are doing it the exact right way. But there are also many who are on Main Street. They're not on Wall Street, who are doing this, and they're doing it for balance sheet preservation. And so it kind of creates this reflexive feedback loop where you're buying Bitcoin for your treasury, right? You're putting it into cold storage, hopefully, right? If you're mandated and you can't do it, it's not in cold storage, it's with some kind of custodian, whatever. You could then take that Bitcoin and earn an actual Bitcoin yield on it, right? Not the Bitcoin yield in the KPI sense, right? Where it's the amount of returns on my equity based on the amount of Bitcoin that I purchased. That's my Bitcoin yield. That's what I'm delivering to shareholders. It's an actual Bitcoin yield for you, for your balance sheet that you're now earning. And it creates this reflexive feedback loop where by posting liquidity to the Lightning Network through a product like Rails, you are making it easier for Bitcoin to transact. You make it easier for Bitcoin to transact. More people may be interested in it. More people buy Bitcoin. It is a boon for the price at the margin, for the time, at the margin, right? But in doing so, you're not just helping the Bitcoin network and helping it increase in price because it's increasing in utility at the margin, but you're also earning a yield on it. And so it's a perfect incentive structure that makes for a future where incentives aren't aligned to basically prey on people, in order to generate yield as a company, but it allows for these companies to generate yield, but the incentives are aligned such that they're lifting humanity up.
I love it. I want to tell a quick story. I went to the Dominican Republic and I hopped on a bus there. And there they've got someone that runs the cash register for the bus, and they charge you based on how far you're going. Now, that is a very manual process, and I think that's where we've been for the Lightning Network, where it's a very manual process to actually run the operations of taking in revenue. But we're moving quickly into an automated sense. So now with Rails and with liquidity subscriptions, you're essentially equipping a business with a tap to pay type of situation where it's just so easy to start accepting revenue. And this type of automation is really what moves forward the payment system. It moves us into a much more automated way, a lot less friction. This is just a more efficient way to do things that helps businesses get paid sooner. Really, this is even if you've got an individual, a small business that wants to start accumulating Bitcoin for its own purposes, they can actually take this Bitcoin and use it to solve an operational problem, because the cash register is being automated and it's being built out of Bitcoin and Bitcoin liquidity. So you can actually be, as a business, be on both sides of this equation. You use your Bitcoin treasury not only for capital preservation, but also to solve an operational problem and in receiving Bitcoin income.
That's absolutely fantastic. And so for businesses large and small, whether you're in the United States or abroad, it sounds like obviously Bitcoin is a no-brainer, but for the people who have come around to Bitcoin, it sounds like Rails is a no-brainer. Not to be too salesy, but it really does sound that way.
The incentives are working out, and I think Bitcoin was going to head this way anyways, but I think we've done a lot of work at Amboss to get the product right and try and dial it in. It works. Bitcoin was already going this way. We're just going to help it along, give it some rails to move forward.
There you go. Give it some rails to move forward. Yeah, it just works, right? That's a fantastic thing to say. All right, phenomenal. Jesse, anything else you'd like to say before we close out here?
Thank you so much, Joe. I'm really glad we got to get your insight in here as well, just because there's so much happening in traditional markets that actually give us a lot of context for why this is completely different, why this is a game changer for not only Bitcoin, but also the global financial system. So it's a pleasure to talk with you, and thank you so much for your writing, and very excited to further the partnership with Thea to help people understand this technology and why it's important and how we can use it to move the world forward.
100%. Absolutely. Happy to be partnering with you guys, and thank you so much for building it. This was sorely needed, and it's only going to get better. So Jesse Shrader, co-founder of Amboss, thank you so much for coming on the show, and thank you for tuning in to an episode of Over the Horizon. If you're interested in more, make sure to check out the rest of our YouTube page, and if you're on X, make sure to reshare, like, and follow so that more people can see this, and you stay notified for when the next episode goes live. That's all for today's video. Thank you so much for watching. We'll talk to you soon.